Hi, this is Eric Sultan with Denver Blockbyblock. I am doing a special episode today where I'm going to have an interview with one of my go-to lenders, Matt Updike from Coline Mortgage. We've been working together for the past 16, 17 years?
At least, yeah.
One of the most knowledgeable guys in the business. And today we're going to be talking about interest rates. We're going to be talking about the Fed rate and how that does and doesn't affect the mortgage rate that you might get on your house, and whether you want to use what interest rates are to make your decision on whether or not to buy or sell. So Matt, let's start with some myths. We hear that the Fed might be reducing or increasing rates. We're actually hearing that today. They might do an increase, they might do a reduction. And a lot of my clients are coming to me saying, hey, I want to wait to see what the interest rates are like before making a decision. And so we're going to wait to see what the Fed does to cut rates.
Yeah, and that just doesn't make a lot of sense because the Fed funds rate is not directly correlated to the 30-year fixed, right? As you know that, we talk about it all the time, but people just seem to get that in their heads. It's the Fed funds rate directly impacts things like credit cards, home equity line of credits, HELOCs, auto loans, but it does not directly impact 30-year fixed. It does historically track it. Like if you look at like a curve, a 50-year curve, you will see, the Fed funds rates and interest rates as long as the 10-year Treasury, which we'll talk about in a second. But no, it doesn't directly. And in fact, sometimes when the Fed cuts rates actually go up because the narrative is generally what impacts the markets and the rates. The Fed's predictions of the likelihood of a cut, like this cut supposedly, or the meeting today, likely will be no cut. That's what the market's got priced in. It's got priced in 25 basis points in September and another 25 at the end of the year. So that's kind of what rates are based on today. If they all of a sudden cut today, it might impact them, because it would be doing something they didn't expect them to do, right? So there you go.
That makes a ton of sense. Also, what I've been doing a little bit of research on this, and it seems like if you have a cut in rates, and if that cut in rates is going to cause inflation, then that might have an effect on Treasuries that you're not looking for. You might have the opposite effect on Treasuries.
Yeah,
what happens when Treasuries change?
Well, Treasuries are more correlated to the 30-year fixed than the Fed funds rate, but the Treasuries go off the narrative of the Fed, right? So like if they all of a sudden cut rates today, I guarantee Treasuries would go bananas, right? Mm-hmm. They would likely go down.
Yep.
Because it's kind of doing what the market kind of wants to happen, but we'll just have to see. The bottom line is what's priced in now is those two cuts. The Treasury yields are kind of correlated to that as well. Both the Treasuries, the Fed funds rate, and the mortgage rates do track each other, but they're not directly correlated. That's the key to, I guess, this whole piece of it, what we're talking about here.
So Matt, I have been studying, but I'm also a realtor, so I don't understand an awful lot of these things. What are Treasuries?
Treasuries, it's what people buy a secure asset or a secure investment as opposed to like an equity, like a stock, right? A stock which might not be considered as predictable, although in today's environment, the Treasuries, that's why we've been seeing kind of a lot of volatility because, basically it's good faith in the American dollar. Our markets, we're kind of the currency of the US, the dollar is what kind of everything tracks off of. And people buy Treasuries to just have a very safe asset, right? That's not going to go under like a business might that's correlated to a stock.
So if Treasuries, like that's 10-year T-bond?
Yeah, you got 2, 5, 10, 30s, correct.
So if those T-bonds go up, then that's...
If the yields go up.
So the yields...
It was the price and the yield, right?
Okay.
Typically yields going up means rates are going up.
Okay.
Right, because you're borrowing for, a higher yield, right? So therefore rates go up.
Is that because these are two of the safest investments that people can make? People inside the United States, people outside the United States, they can invest in purchases of houses, these 30-year loans that you produce.
Well, now we're talking about the mortgage-backed securities, right? So that's
okay.
Maybe a little bit different than the Treasuries, but they're correlated as well. But yeah, people, you buy mortgage-backed securities because you feel like it's tied to a home right in the end. So that's something that people generally aren't going to default on, I guess, right? Although 2008, we saw what happened there, right?
Sure. So Matt, right now we've got like a 4.5% Treasury, but interest rates are significantly higher than that. What's really driving mortgage rates?
Yeah, Eric. So, historically, we've seen about a 1.5% spread between the 10-year Treasury and a 30-year fixed mortgage rate. But lately, and for quite a while now, we've been seeing more of like a 2% difference. And that other 0.5% really built in there just because banks are not as confident with our economy and where things are, and they're kind of hedging risk on inflation and market volatility.
Cool. That makes sense. That really tracks with things that I've been telling my clients. I've been telling my clients that the interest rates have really become kind of untethered from the Fed rates and even from Treasury yields just over the past few years.
Yeah, so there's no guarantee that a Fed rate cut means lower mortgage rates. I mean, that's kind of the bottom line take from that. You got to follow the 10-year Treasury closer to the Fed funds rate, which will follow the Fed funds rate, but it's definitely not something you could follow when you're trying to buy a home and file it day to day. It's not going to work out.
So if people say, hey, I want to wait until next year to buy a home because next year I hear that the Fed is going to reduce interest rates a lot, that might not be the best. I mean,
right.
I'm kind of leading you into this question.
Yeah, I understand. And it's the talk of, a new Fed chair and what they might do. And, are they just going to cut rates blindly? Well, that may or may not work. And there's some of the other things to think about there too, as well as, on the real estate side, Eric, that if somebody waits for lower rates, well, you're going to have more buyers now, right? So, and prices will likely go up. Versus say you buy now, which is a great market for a buyer right now in most cases, and then rates come down, well, you do what's called a refinance. I mean, most people know what that means. So, this isn't your forever rate, this rate today, based on so that's a much better way to look at it. Now, there's affordability issues too. If you just cannot afford the home that you want because of where rates are, that's something you have to take into account too.
So that's why I always tell my clients, you marry the house, you date the rate. Rates go up and down, but the house is something that you're going to hold on to for at least 3 or 5 years.
Right. And we've also got other tools to get people in now. We've got things like rate buydowns, seller finance, seller paid buydowns. We've got, large people are getting large seller concessions. And then you have refinance options down the road. So really, when you're ready to buy, you should be buying a house when you're ready to buy a house, right? Yeah. And as long as the affordability is there, or as long as you have the ability to buy the home, I feel like it's always worth having that discussion with a realtor and your lender.
For sure. That's a conversation that I have all the time. Probably has something to do with being around you for all these years.
Yeah.
But yeah, when people ask me, when should I buy? It's when you're ready. When you're ready to be when you're ready to own the home, whether you live there or not, whether you're ready to own the home for at least 3 and more preferably 5 years. If you have 5 years, you can ride out just about any problem that might come up. If somebody's watching this right now and they're thinking, what should I do? I'm kind of on the fence about buying a house. What's your best advice for them?
Well, first of all, talk to a local lender. Don't be messing around with online calculators, looking up a home on Zillow, messing around with an online calculator, trying to figure out what you can afford on your own and you might be screwing up the payment anyway, whatever kind of taxes, insurance, you're estimated mortgage insurance, all that stuff. So talk to a local lender, get an idea of what you can afford now. Maybe it'll surprise you, come up with a plan, and if it's not there, it's not there right now, but at least you'll know. And then if it is, you might be surprised. And, to me, if you can't afford to buy a home and you can get into the home you want, why not move on that sooner than later? And then what we talked about earlier, your refinance or something might be down the road when rates come down.
Yeah, I tell people all the time, listen, we're going to be in this business for the next 10, 15 years at least.
Yeah.
We're not in any kind of hurry for you to buy your home.
Right.
We're not in any kind of hurry for you to sell your home. We want whoever our clients are, we want them to make the best decision for them at the best time possible.
Right. Yeah. And I mean, we've been doing this a long time together, Eric. And I mean, I can't think of too many people that over these, 16, 17 years we've been working together and 20 years I've been in the business that bought a house and then it would have made more sense to wait. It's very rare.
I'll tell you where that's happened. And I every time that I've seen that happen, it's been when somebody bought a house and they kind of knew in the back of their head, they knew that they might have to leave that house, they might have to sell it to leave it within the next couple of years. If you've got 3 years, if you've got 5 years, then you're going to be protected. You're probably going to make money, and usually over 5 years, you're going to make an awful lot of money. And I'll link to another video discussing how you take that first home purchase, often the first home purchase, and then you move what you've made from that first home purchase into that next home purchase. So you might have, I don't want to get off too far into this, but you might have 5% or 3.5% down on your first home purchase, but you use that purchase and then the sale that follows that to create a 10 or 20% down purchase on your next home, which is usually a home that works even better for you than that first home did.
Yeah, I feel like we've had several clients do it over the years.
Oh, yeah, tons.
Yeah.
So when interest rates do come down, there's a dynamic that happens. When those interest rates come down, then you start getting a lot more applications for loans. I start getting a lot more people calling me to buy houses. All the realtors wind up with a ton more calls with people who want to buy houses. When you have a lot more people who want to buy houses, then what you wind up getting is a reduction in supply, an increase in demand, and then the price of the home goes up. When home prices go up, you buy a more expensive house, that purchase price isn't going to change until you sell the house, buy your next house. Interest rates change all the time. They change every day, and if they change enough, then you can leverage that low home price, that low purchase price, along with a lower interest rate to really reduce your payment. If you have a lower interest rate, but you have a higher purchase price when you make your purchase, then you're just going to have a higher payment anyway.
Right. Yeah, I mean, one of the first things I was taught when I got into this business 20 years ago was you can't buy on rate. It's impossible to time the market. Buy when you're ready to buy a house, and whether it's a short term and you're gonna upgrade and you're gonna become an investor and buy multiple homes and stack one on top of the other, which can be a great plan. It's worked for some of our clients over the past several years, obviously, with the way things have been going around Colorado. But buy when you're ready to buy, and if you're waiting on the rates, you're gonna drive yourself crazy. So.
Absolutely. Yeah. And then you're going to wind up being one of those people. I have these conversations maybe with 1 in 4, 1 in 5 people that wind up buying with me. They were looking 2 years ago, and then they didn't make the decision. And then they start looking. And as they start looking again, in one way or another, the homes only became more expensive for them.
Right.
We just had a closing recently with somebody who this was the exact situation that she got herself into, where she was looking and she felt like there was too much competition in the market and didn't want to get into bidding wars, didn't want to buy a house where the prices were at the top of the market. And then she stopped looking, and then she wound up getting involved. It was after 2 years, and the prices had actually really stabilized. Prices hadn't gone up, but they also hadn't come down. What had gone up, what stabilized the prices, was interest rates went way up. So then she was looking at a home about the same price with a significantly higher interest rate, significantly higher payment.
Yeah, that's why you don't want to wait.
Yeah, we made it work. Well, let's wrap this up. A huge thanks to Matt Updike for being here with us today.
Sure.
I think that you helped get an awful lot of clarity for a lot of our watchers and listeners, helped figure out, hopefully you gave people some insight so that they understand what the price of sitting on the sidelines, waiting for the Fed to make decisions that they might or might not make, those decisions that might or might not be associated with interest rates at all. I think that you helped those people out an awful lot. I just want to say a hearty thank you to you, Matt, for being here today.
Thank you, Eric. Appreciate it.
You got it. And if you want to know more about what it's like to buy or sell a home in Denver, how those interest rates and prices might or might not affect you, please feel free to respond to me in the comments below. You're welcome to email me, email Matt. We'll have Matt's information. You can always get it from me, or we'll have it in the notes below. And if you're ready to start exploring purchasing or selling, let's be smart about it. Get in touch with a knowledgeable local realtor wherever you are. Get in touch with a knowledgeable local lender, not an online lender, somebody who really understands what's going on in the market where you are, wherever that is. If you need help finding any of those people in your market, you're welcome to get in touch with me. I have great resources all around the country, and I'm always happy to get you in touch with a great local lender and a great local realtor wherever you are. This has been Denver Block by Block. I'm Eric Sultan. This is Matt Updike. Thank you so much, and we'll see you next week.